Welcome back to another Market Monday.
Yeah, man, it's good to be here. Good to
Yeah,
be here.
we coordinated outfits on an accident, so
Yeah. Well, I figured I would dress up.
you know what? I like the Snoopy shirt.
Yeah, I think so
Well,
too.
compared to last week, dude, you had the sport coat on and everything last
Yeah,
week.
jackets are for
So,
closings, and so I had a closing that day. And yeah, I don't have a closing today. I've been actually kind of running around all over today.
have you?
Yeah, yeah. I don't know about you, but I had a decent weekend. I'm not just in the Kansas City market. I'm in a couple other states, and had a couple clients get under contract in
Nice, dude.
Virginia, and yeah, and plenty of people looking here in Kansas City. What about you? How was your
Nice.
weekend?
I told you I wrote an offer over in
Yeah,
Olathe, which honestly that's my first offer I've ever written in Kansas.
nice.
So like the Overland Park,
Yeah,
Olathe, Leawood area,
yeah.
dude, it's a different animal out there.
How so?
So my client sent me 4 different houses that she wanted to go look at on Thursday. You know, usually houses hit the market on Thursday. So she's like, hey, all these new houses just hit the market. Let's go check them out this weekend. That day, 2 went under contract of the 4.
Yeah,
So I'm like, okay, we'll go check out the other 2. One needed like quite a bit of work as far as like siding and stuff goes. Like had some wood rot and all
yeah.
that stuff. And so she like wasn't, and like super old windows. So she wasn't super excited about it. That one went pending that day.
Mm-hmm.
And there was like 3 or 4 showings while we were there. So just like
Yeah,
people just cycling through the door. And then we end up writing on the second house we went to go see. Lost it. I just got done talking to the agent. There were 6 offers on it. The went crazy over list price,
yeah,
like crazy appraisal gaps, all that type of stuff. So uh, I don't know. Just it seems like there's a lot more activity down there than there is
yeah,
like here in the Northland. Because like the market's hot both places, but as
yeah,
far as activity goes, I mean, there's not unless it's like a super super hot listing that just hit the market. Like you might get like some overlapping showings,
yeah.
especially at like a like a starter home price, like a 200,
Right.
250, in Liberty or something like super desirable. But I mean, these were 350 houses,
Yeah,
and which are in demand in the Northland too. But you just
yeah,
don't see like quite so much traffic. So like the fact that like we just had overlapping showings everywhere we were
yeah,
going on a contract before we can even get there, type of deal. I mean, you see that a little bit here in the Northland, but it doesn't
yeah.
seem like quite to the extent.
I mean, it can be neighborhood specific. It
Yeah,
can be property specific. I mean, there are parts of Johnson County that are not as hot, but just in general, the Kansas City suburbs on that side. I mean, there's just a lot of
yeah,
people that live there,
yeah,
right? And
for
and
sure.
so and in those price points, I mean, that's the thing that I think is makes. And I live up north, but I've also lived in like Western Shawnee.
Yeah,
That's the thing that as far as the Northland goes, is it's still even now still a bit of a hidden gem in terms of like
for
overall
sure.
value.
Yeah,
But a lot of people that live in Kansas, they work in Kansas, their kids are going to school in Kansas, that type of stuff. They're gonna that's where they're going to
yeah,
be.
yeah.
And so yeah. So did you win the deal or
No, we
what?
lost it.
Oh, okay,
Yeah, we
okay,
got.
right on.
We didn't even hear back from the agent. Like
Yeah,
they're like, hey, we'll know by 5 o'clock. Nothing. Still, I'm like looking on MLS to see if it like had flipped to pending yet. Texted her at 9 o'clock, and I was like, hey, do you guys come up? Sellers make a decision yet? No response. And I'm
yeah,
like, wow, is our offer just like that far off? And so she said, I just got done talking to her, and she's like, hey, my assistant said she left you a message, but you must not have seen it. And I was like, yeah, I mean, I don't have any like missed calls on my
yeah,
phone, but it's, maybe my phone's messed up. Who knows? But she was actually helpful. Like they had 6 offers total, and she like kind of broke down each one about like, maybe why ours didn't win. And really it was like everybody's kind of there in price, but we had like, there was a few escalation clauses. A few people
hmm,
had enough money to do an appraisal waiver and stuff like that. So, I mean, at the end of the day, it just comes down to, I mean, money is really like the biggest
right,
thing, right? Like you can only, like we gave her everything we got.
yeah,
And if there's other people that have more money, it's just sometimes it's hard to win those deals. And,
yeah,
sometimes you get a scenario where like a seller needs like a specific close date or, fast or slow or delayed possession, something like that. And then you can sometimes win an offer that way without having to go
yeah,
crazy on price. But in this scenario, the people just wanted highest and best, and they were super flexible on closing. So,
yeah.
I mean, we maxed out the pre-approval and still weren't able to get it. So,
Yeah. Well, it's interesting that you say that because for me personally, over the last few weeks, most of the scenarios that I've put together have been based on the ability to close quickly.
yeah,
And so it's, in fact, I mean, one of them we were not the highest. We were not the highest offer, but I mean, like time is money, right? And for
mm-hmm,
some people, like the urgency of
yeah,
making it quick.
for sure.
And so, I was fortunate. that the people, my clients, did what they needed to do up front to make sure we were pre-approved and like ready to go. But it's interesting that you bring up like the appraisal waiver, because I have that can be, if you're putting, so they've actually changed those guidelines. In the past on conventional, you had to put 20% down to get an appraisal waiver. And it's just something that trips in the system. There's enough historical data on that address to support the value.
Right.
The client's got the money down, they've got the credit. I mean, there's a whole algorithm that goes to it. Well, recently they've actually changed that to just 10% down.
Oh, really?
So you can, yeah, I mean, now I don't know anybody who's actually seen a 10% down like pop up in the system.
Yeah.
So, I would assume that you have to be very, very solid credit wise, DTI, all that type of stuff. But that is something that, I've been in situations with people that are going in on an offer, and we have proactively ran it through the system to see if we can get that appraisal waiver. We get that appraisal waiver up to a certain amount of money, and, so we can present that.
Yeah.
I mean, if there's a loan, there's going to be an appraisal, and it's going to be a pretty important aspect of the transaction. But if you can basically show that you have the ability to cover the offset, like whatever your appraisal shortfall is, then yeah, I mean,
it really makes your offer stand out.
Right.
Yeah.
Right.
So there's only really like two big hurdles, right? It's the inspection and the appraisal. So if you can get the appraisal waiver, you've kind of taken one of the big roadblocks out of the way, right? Something for the sellers not to worry about.
The inspection is not something that I would prefer not to see the inspection.
Well, yeah. I mean, as far as like getting a deal to close, right?
Yeah.
So like, there's two big hurdles. You gotta, first you gotta get your offer accepted. You gotta get past inspections, like on my side, and then I gotta get past appraisals, right? So like, especially from like a listing agent standpoint, if I have offers that are waiving the appraisal, I'm like,
right.
That's like one of our big headaches, right? Like, like I have an appraisal headache right now, right? So it's like, if we can have an appraisal waiver, that just takes a load, 33% of the stress off. Because really, you got to get the offer, you got to get the inspection, you got to get the appraisal. So
but they're not. I mean, they're not. I've had situations with people that are putting like 40% down, and bullets credit, everything like makes sense, and
you still don't get it.
The system doesn't take it. So it's just one of those things where
it is weird.
Whatever the algorithm is, like but it's a nice tool. But the majority of the people that I work with do not have like the 20% down.
Right.
I mean, most people, or 10%. But again, you just don't see those.
Yeah. But, which actually leads us to our topic. Actually, were you about to say something?
Well, I was going to say, I mean, it's definitely heating up, like the market.
Oh, for
sure. And I mean, you're in Johnson County when you're talking about that situation, but just going around this weekend looking at open houses, everybody was busy.
Yeah, it's nuts, dude.
Just takes nice weather and everybody's ready to go.
Sam just had a little listing in Gladstone hit the market for $200K. I think it was a 3-bed 1-bath. Yeah. But saw a little property, and it went nuts. Like it went like thousands and thousands and thousands over asking, like as is box 2. Like all kinds of stuff. So we were talking. We're like, dude, something flips. Like when this weather gets nicer, people just come out of the woodwork ready to.
I mean, I've been in this business since the beginning of 2022, and I've been waiting for the switch to flip entire. You know what I mean? Like maybe now's the time. So, So what were you gonna say? You were gonna bring us to our topic here.
Yeah. So it's talking about money and appraisals and blah that stuff. I kind of wanted to get into like different loan types and like purchase power and all that type of stuff, because last week we talked about, like, is now the right time to buy, right? And so it's like, okay, the next logical question is, okay, yes, it is now the time to buy. Like, what's that look like? Like, what's a conventional loan? What's a FHA loan? Because you get people that ask about, like, hey, I saw a USDA loan is 0% down, or like, hey, what about down payment assistance? And so there's pros and cons to every single loan program, I believe. And so I figured it'd be good just to kind of educate people on, like, what are the main like loan types? What are the pros and cons of each one? Why would you want to try to maybe go conventional instead of FHA, and like kind of qualifications and stuff on that? And
so there are generally really 3 major ways people finance like their primary mortgage, like their primary residence. You have conventional financing, and then you have the government loans, FHA and VA. Now, you mentioned USDA. I mean, USDA is a government loan, and that is something that we have an option for. We just don't see it as often as those other 3. And so if you start out with like conventional is, typically, that is somebody who has, 720 or higher credit. Not always. I mean, you can be, have lower credit than that. But as a first-time home buyer, you can put as little as 3% down of the purchase price. You have, as far as, the things that you need to be aware of, debt to income on a conventional mortgage is 50%.
Okay.
So you need to have like everything that, including the housing payment, you need to be under 50%. And if you're not putting 3% down on a conventional mortgage, you're going to have monthly mortgage insurance. And that's something, or if you're not putting 20% down, you're going to have the monthly mortgage insurance. It tends to be the preferred way to finance because there's no, while you do have the monthly insurance, you do not have like the upfront mortgage insurance premium that you would have with something like FHA.
Okay.
Rate wise, it's what most of the rates that you see quoted are going to be conventional rates.
Right.
They tend to be somewhat higher than the government loans, like the FHA and the conventional. But overall costs, they tend to be the way that people are going to proceed. If you're selling the property, you want to see a conventional mortgage, conventional offer, because your government loans like FHA and VA will typically have some additional things that need to be addressed.
Right.
Like peeling paint. I mean, we've had situations like that, different things like that. But yeah, conventional mortgage is typically where if somebody can go conventional, they're going to go conventional.
Right.
And so, the closing costs tend to be lower than like the FHA as well. I'm just looking at my notes here to see if there's something that I've, And so that's conventional. It's pretty basic. And then you'll see a lot of FHA.
Yep.
And so that's a government program where they insure the loan or guarantee the loan, one or the other. It means the same thing to me.
Right.
but FHA is nice because and it's you do 3.5% is the minimum requirement. So it's a low down payment. The rates tend to be a little bit better than conventional, and then income wise, I mean, I've done FHA scenarios with people in the high 500 credit scores. So the underwriting or the credit score requirement, it's not as high. You get more in terms of debt to income as well. So I think it caps at like 56.99% of your income. Now, some banks will have what they call overlays, and even though the program itself will give you up to 56.9999 debt to income, they will cap it at 50%.
Okay.
They might do something where they'll have a credit minimum. I was at a bank for a period of time that had a minimum credit score, I think of like 640,
Okay.
and FHA had to be under DTI had to be under 50%.
Okay.
We don't have any of those. So basically,
Right.
if you qualify for the program as it is,
You're good to go.
Yeah, you would be good to go. You're going to have monthly mortgage insurance on an FHA loan, and then you're going to have the upfront mortgage premium, which basically it's like 1.75% of the sale price is added to the mortgage. You don't pay for it. Some people will pay for it in their closing costs, but it's basically just added on to the loan. And that's because again it's an insured deal. It is it's credit wise, typically it's slightly riskier profiles because of the lower scores.
Right.
But I mean it's a good program, and I know people will qualify for have higher credit scores and qualify for conventional, but strategically they'll go with FHA.
Right.
Some of your
because you get the lower rate, so it can
you get the lower rate.
The money makes more sense sometimes.
Yeah, and if you're buying like a duplex or something like that that you're going to live in, you can put less money down in that scenario versus the conventional. Mm-hmm. And so and then let's see any other it's just primary residences. So on a conventional mortgage, you can have a second home, you can do an investment property, but FHA it's something you're going to have to live in.
Yeah.
And so, question?
No, just like summarizing that, it seems like FHA is kind of it's more accessible to more people.
Yeah.
Right. It's easier to get your foot in the door, and you might be able to qualify easier for an FHA loan versus maybe a conventional.
Yeah.
Versus money up front wise. I mean, 3% down conventional versus 3.5% down FHA seem pretty neck and neck. Yeah. People don't usually pay their mortgage insurance up front.
No,
with
not
the
the upfront thing. No, I mean
Okay.
you can. We've had people like strategically do some things where they, but generally they don't. Generally they roll that. And so it's just one of those things where you can be strategic about it. A lot of times people think that FHA I don't know if it's because of the FH or whatever, that they assume that's like the first time home buyer program.
Yeah. Mm-hmm.
And for a lot of people, it is the best way for them to buy the first time because of the credit restrictions or the lower scores. the higher DTI, but conventional has first time
Yeah.
buyer programs as well. And then really in this area, the next biggest one is probably VA, which is an awesome program.
Yeah,
I mean, when my
for
son
sure.
like went into the Coast Guard, this was one of the things I was like, dude, this is great because
Yeah.
a VA. So basically, you retire from the military, you leave the military, you have eligibility, which we can verify. Basically, what it allows you to do is buy a house zero down. Credit score type stuff. I've had people qualify in the 500s. There's DTI. There's not a cap to the DTI.
Right.
I mean, I have a transaction right now that's a 72% DTI.
Gosh, that's crazy.
But they have another factor. They have in the VA, they look at what's called residual income, and so whereas FHA and conventional, you're just looking at effectively the debts that are showing up on like credit bureaus or things like child support, all that type of stuff that you have to document to calculate that into. The VA wants to make sure that after everything, estimates for utilities, childcare, all that type of stuff, there's still a certain amount of money left over. That's called residual income that basically the veteran, the borrower, has to still cover like additional expenses.
Okay.
And so that's tied to the different regions. We're obviously in the Midwest, and then it's tied to the family size as well.
Okay.
But it's a great program because it doesn't have, you can do 100% financing. You still have to pay the closing costs.
Right.
But you can do 100% financing, and you don't have monthly mortgage insurance as well. Now, there is a funding fee associated with it, similar to like the FHA upfront deal. I mean, it's a fee, and so first time use, it's a smaller fee, and then it's larger subsequent uses as well. But if you collect military-related disability, that's potentially waived. So there's no funding fee.
Okay.
You can have it's for primary residences, but you can actually have a home that you purchased as a primary residence, and then a couple of years later you want to buy another home, keep that home as like a rental property or investment property. Well, you can do that. There's an entitlement formula based on the properties that you own, and so it's possible. A lot of times people don't realize this, but it's possible to have multiple VA loans. It's just all
really?
tied to how many, how much entitlement they have remaining, which is tied to kind of like the loan limit in the county, what their balance is on the for the new property, that type of stuff. But VA is great, and the rates tend to be the rates are lower on a VA scenario.
They're close to FHA, right?
Yeah. But again, with VA you have, similar to the FHA, you've got the other requirements as far as the inspection goes.
Yeah, so I wanted to get into that because sometimes you get somebody that let's say they're FHA, right, and then I go in, I set them up on their search on MLS, FHA eligible properties, and some properties aren't listed FHA eligible because maybe they have some wood rot or chipping paint or something like that. And then you get, the client will like send me something off of Zillow. Hey, I really want to go see this house. Oh, it's not FHA eligible, right? So, and really with that, we're talking about the appraisal, right? So like the appraiser comes out, you want to explain kind of how the appraisal works with like having somebody come out to inspect the property and all that stuff, getting flagged. Cause I actually have a wood rot appraisal FHA issue right now. So,
and so I mean, it's just again because it's a government insured or guaranteed mortgage. There's just more restrictions with the property and the condition of the property. Things that might not show something that might not show up on a conventional mortgage, conventional appraisal will show up on an FHA or VA. But nowadays it seems like that conventional appraiser is going to call it out as well. And so, I mean, things like wood rot, there's a termite inspection on, all the properties. VA, depending on what part of the country you're in, you may not have them, but we're in a place where you have to have it. And so if termite comes back and there's evidence, you've got to do some mitigation, you have to document that type of stuff. Anything that comes back on one of these appraisals that needs to be addressed, like peeling paint. So I had a situation in Springfield with a house that had a deck that had some like goofy boards
funky
on
stuff,
it. Yeah, and it was a VA mortgage, VA loan that we were doing, and no, I'm sorry, it was an FHA loan, and the appraiser themselves actually didn't point it out. but there were photos that he included that were like, this is a problem. Like this deck is like
Yeah.
an issue. And and that can happen. So the underwriter was like, hey, what's going on with all of this? And then the appraiser sends us back, yeah, sorry, meant to note that was kind of a weird deal. And so we had to, for us to close, that had to be addressed, and that inspector had to go back out
Yeah.
and physically look at it. The interesting thing is they just tore the deck out.
Really?
They like just tore the deck out like completely. They've got put in steps and a handrail or whatever coming out
There you
of
go.
the back door, and that's how
That's
they
the
addressed
fix.
it.
Yeah.
But we've also had situations. So I had another VA scenario where there was peeling paint on the detached garage, and so those structures on those property they need to be addressed. They need to be addressed as well. But it's again, these are things that could potentially be pointed out on a conventional appraisal.
It's funny you say that because this FHA appraisal thing that I'm dealing with right now, the FHA buyer, we go check the house out and like we see wood rot all over like the some of like the trim boards around the
Yeah.
windows and stuff, and it's a pretty specific scenario. This house had been on the market, went under contract, and then financing fell through, so it went back on the market. And I said, hey, if we write offer on this, like we're going to have some issues with the wood rot with FHA.
Yeah.
So we write on it, basically set the expectation with the seller that, hey, like, we're going to need all the wood rot fixed after inspections and whatnot,
Yeah.
assuming we get to that point. So we do inspections, everything's fine. And we're saying, hey, we write the resolution basically saying, hey, all the wood rot needs to be fixed so we can pass FHA appraisal. And like, it's pretty bad wood rot. Like, I'll show you pictures later, but
Yeah.
dude, the appraiser comes out, flags it at value, no conditions. And like, there's literally wood falling off of this thing.
Yeah.
And so we, as the buyer, we wanted all the wood rot to get flagged because
Yeah.
he didn't want to buy the house with all the wood rot.
Right.
But we said, hey, like, there's no way that's going to pass appraisal at being FHA, and it did. So we had to actually go back to the lender and say, hey, and I've never worked with this guy before, just some random guy that my client came pre-approved
Yeah.
with from like, I don't even heard of the company before.
Right.
But I call the guy and I'm like, hey, in what world is this not going to pass? Like, in what world is this okay on FHA? And he's
Yeah.
like, oh, the appraisal doesn't look very bad. And the picture the appraiser took is like of one side of the house with like a tiny little bit of wood rot. And so I was like, dude, look at the inspection reports. Usually the lenders don't get the inspection reports, right? But I screenshotted some of the pictures of the wood rot, and the lender's like, oh my gosh, this guy like didn't want to do his job that day or
Yeah.
something. So we actually ended up getting it flipped to where now all the wood rot needs to be fixed.
Yeah.
Right. So now we're going through this issue of like the seller didn't have this like clear cut list of all the wood rot that needed to be fixed. So they just fixed some of it. So then I went over there yesterday to check it out. They still need some more work done. So now we're going back and forth trying to figure out what all needs to be fixed. And
Yeah.
we were supposed to close it today, but now we're having this issue, right? So now we're making sure all the wood rot gets fixed before the appraiser comes back out for reinspection and blah, 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 blah. So isn't it weird how some appraiser, like there's no consistency with appraisers? Like, do you see that quite a bit?
I mean, I think the thing you have to remember is they're people.
Yeah.
Do you know what I mean?
Yeah,
and
yeah.
some people do a better job than others. But I mean, from my experience, I have not. I mean, the deck thing that I mentioned, that was the only time I've ever seen something like that.
Really?
Yeah, and so I also think it's interesting because there are a lot of people that I think would get that appraisal and be like, okay, we're good to go. But you had addressed it up front with the client as well.
Yeah, and the client like didn't want to move forward because he
Yeah.
was like, what I mean, because then you get water
Yeah.
and it's the wood's just going to keep on rotting away and stuff. So
I've had situations where people have on like an FHA scenario or VA scenario where they have waived inspections because they knew the FHA appraisal was going to, you know what I mean?
dude, lesson learned though,
Yeah.
because like in the resolutions I put wood rot and chipping paint to be fixed per FHA appraisal. So I was basically like banking on
Right.
on the appraiser to come back and flag it for us, and he didn't. So like going forward, I'm gonna have to like be more specific with that and be like, I can't trust these appraisers, even if it's like, dude, like it's in plain sight, like right underneath the front window, like the board is just like
Yeah.
literally rotting away. And so like, I never would have thought that would have not
Yeah.
got flagged, but it did. It didn't get flagged. So
Yeah.
now we had to go back and get, kind of fight that battle. But yeah, I guess you just never really know.
I wouldn't recommend like waiving inspections.
No,
I mean,
never,
I
no,
would do
yeah.
it 100% of the time. In fact, I have a scenario closing at the end of this month on a new construction, and my client is having inspections, and the
Yeah.
builder's like, "What?" And I was like, "Well, yeah. I mean, this, again, it's
dude.
still built by people, and so it's a little bit of money, but I think the the FHA VA deal where you know kind of waive inspections for the appraisal, I get that in terms of a strategy, but I also feel like especially FHA, when you look at a situation where people are maybe not qualifying on conventional, right? This makes it easier for less qualified people to be homeowners, right? Less well qualified buyers. It's not that they can't make the payment. It's not that they don't deserve to be homeowners. It's just that like it's a box that's easier to fit in, right? And so it does seem sort of like a disservice to not, you know, for those people, to not have the inspection.
For sure.
But yeah, that's I mean, it happens.
Yeah, I mean,
things
it is
can
what
be
it is.
missed, but
Yeah.
in general, you know, I
usually do a pretty good job. That's why I
Yeah.
kind of like banked on that. But again,
Huh.
you learn something new on every deal, right? So
Right.
yeah, so it is what it is. But speaking of like fitting in, like it's an easier box to fit in FHA versus conventional. Do you have any tips for people as far as like increasing purchase power or ways to improve their financing so that maybe they can flip to a conventional or even just be in a better spot FHA?
Yeah, I mean, one, pay all your bills on time. You know, I mean,
What?
be mindful of your credit situation. You know, don't, you know, if you can pay some stuff off, because again, DTI it's all about debt to income, right?
Right.
And so if you've got something that is got like a $20 a month, but like $150 balance or something like that, get that stuff paid off.
Yeah.
Knock all that stuff out because every dollar counts in DTI. Every percent in DTI is like basically more house that you
Right.
can qualify for. You know, so obviously, you know, the credit stuff, make sure you're good there. I would say that in terms of if you're be salaried. I mean, I know that's like
Get a salary,
that's
high-paying job. No.
It's just, you know, if you're an hourly employee, it sucks, but variable income like that is calculated differently than like salary. Salary is nice because it's just like right there.
Boom,
It's
yeah.
consistent. It's always the same thing. So it's very easy to calculate that.
So you guys hate self-employed
It's
folks
not that
like
we
me?
hate self-employed. Well, so here's my issue with self-employed is an issue with the guidelines, okay? Because if you're self-employed, you need 2 years of tax history to establish your income.
Right.
And if you're self-employed and you're doing your taxes, what is your strategy when it comes to doing your taxes? It's to minimize what you owe to the IRS.
Right.
Well, the way you do that is you figure it out to make it
Deductions.
show, to show that you have less income. Well, that's counterintuitive to what you're trying to accomplish.
Yeah.
And so I sort of get frustrated because I think the guidelines are suck.
Yeah.
You know what I mean? You can have somebody who is self-employed. He has shown that he can like manage his business, credit, all that stuff shows that he qualifies.
Yeah.
But his income gets calculated in a way that he doesn't. But you can have a guy with a job letter who's going to graduate next week from college with a salary, and that guy qualifies.
Yeah.
And so I mean, my advice would be, you know, if you're self-employed, I mean, you're just going to have to be strategic about that. And you know, but I mean, that's 2 years of taxes that you have to average, right?
Yeah.
So if you're self-employed, just know that like, you know, you might need to, and I think we've talked about this with you before, being strategic about, because you're effectively self-employed, right?
Yeah.
And so
1099,
you may take a hit in a year to show that you have more income to qualify.
Well, that's what we're doing this year. So like the whole thing that made me think about this whole purchase power thing too was, you know, because buying a house is on our radar this year, and so I got to get my 2024 taxes all done, right? But I can't deduct too much because then it affects my purchase power, all that stuff. But what really made me think about purchase power for like just normal people, is on Saturday, whenever I made a little story saying like I'm putting some miles on the Trailblazer, right? I'm going to Olathe, and I got appointments in Olathe, I got appointments in Excelsior, blah blah. And then my next thing, I think I even was talking to you on the phone. I was like, "Hey, dude, my car's making a weird sound. I don't know what's going on."
Yeah.
And my the timing chain or whatever broke, right? So then it's like I'm stuck in like the Quick Trip parking lot with like a broken belt, right? Like the inspector had to come pick me up from the Quick Trip parking lot to bring me to the inspection, and we figured the car stuff out later. But multiple people were like, "Dude, you need to get a new car." And I'm like, the last thing I'm going to do is pick up a car payment right now if I'm trying to buy a house and I got to pay my taxes and blah, blah, that stuff.
Yeah.
And I've seen it, so like, I don't want to mess up my debt to income, right? Because if I go get a $500 truck payment, that's going to mess up my debt to income right now. now instead of me being able to qualify for, the house that I want, now I got, a nice truck in the driveway. I don't really care about that, right?
Right.
But I've seen a lot of times where, especially people like maybe, they the whole champagne taste on a beer budget, right? So we got somebody that wants a 350 house and they qualify for 200, but then when you go to you start looking at their finances and like their debt to income, and they got a $700 truck payment on a new Silverado, and it's like, bro, just sell the freaking truck and you can get the house that you want. But again, it's America, we're consumers, we have to keep up with the Joneses and have the this nice new shiny car in the driveway and front like we got all this money and stuff. And I just think it's such an easy thing to leverage of like just drive some crappy beater car and keep that money in your bank account, whether you're buying a house or not, right? Like we all know that cars lose value over time unless you got like a collector's Porsche or something, right? But overall, a lot of the rich people I know built that by driving 1992 Honda Civics while they built their wealth up. And then once they could actually afford to buy nice cars, probably paid in full, then they started driving the nice cars around.
Yeah, my opinion on whether or not you should have like auto debt has changed over the last few years. But no, I mean, I will see scenarios where somebody is making $4,000 a month and they have a $700 car payment. In fact, there's consumer there's a lot of consumer debt right now.
And I think
right? And I think the average new car payment is like $620, something like that. The average used car payment is $500.
Yeah.
I mean that is when I was the general sales manager at a big Toyota dealership, I started like buying stupid cars. But prior to that, I'd never had anything.
Dude, I used to buy stupid cars. Yeah. Like I was like 21 years old.
Yeah.
And bought a $25,000 WRX because I wanted to flex on people and have a loud, race people and have the loud exhaust and blah blah stuff. So like I've been there, done that.
I can see you. I know that. Like you see that car coming in, that guy wanting to trade, or you see the kid coming to look at that car when you have it on the lot.
Dude, that's totally me.
Yeah.
Like literally. Like still living with my parents, whole paycheck going towards paying off this car that there's no way in the world I could afford if I actually was like having to support myself. And so like, and then I sold that thing because I switched jobs, took a huge pay cut, couldn't even afford the car payment anymore, had to trade it in, was upside down on it, still had to flex, so I had to get a BMW. I got an old 3 Series with like 160,000 miles on it. And then I'm upside. I got an $8,000 car with a $12,000 loan because I was $4,000 upside down on the WRX.
Yeah.
And this thing's breaking every other month, and it's a BMW, so it's expensive as heck. So I dug myself out of that hole, and I think that's the lesson that I learned. I'm like, dude, I'll drive an old Chevy all day where I can. Again, I paid. I mean, thankfully my buddy was able to help me out get that belt fixed, but like, I mean, it cost me $200 to get that fixed. I'm like, that's not even half a car payment if I had a car payment every month.
Yeah, I got a client right now that I have pre-approved, looking in Johnson County, and when I did the initial deal for his budget, I was $500 away, and I'm like, can we look at refinancing this car? Can we do this? And he, in like 10 minutes later, he sent me basically the documentation showing that he had already refinanced it, and he lowered his payment by $500. It was like,
damn.
But I mean, that's luck more often than not. Because I had another scenario on a deal in Smithville where we figured out from the time he pre-approved to the time like prior to close, he had bought like another car. And that was it ended up working out, but it was like, you did what? Like that's exactly the thing that like you're not supposed to do. But people spend. I mean, you just. It's what's your priority, right?
Exactly.
I mean, if a big car payment is what you want, and it's a tight budget. I mean, it could be restrictive to qualifying for a mortgage, but we will have people refinance. It's pretty common, and credit unions and stuff can do that pretty quickly. But I mean, it's just about like what are your priorities?
100%.
And so a couple things that you can do. If you've got something you can pay off, pay it off. If you got something you can refinance, refinance it to lower the payment. But if you're an hourly employee, you need to make sure that like you're working 40 hours. You need to maximize your time. Don't like start like taking time off in a way that like you're not, you know, getting paid for it.
Right.
You know, if you're somebody who has the benefit of overtime, you know, because the thing about hourly is they take, you know, they're going to take, in most cases, they're going to take a 2-year history and they're going to average that, you know. And so if you're somebody who gets overtime, you know, commissions, I mean, it's the same thing. You have a 2-year history. And so like, don't take your foot off the gas if you're trying to qualify for something.
Yeah.
And that's another difference, you know, on as far as the loan types we were talking about earlier. FHA, VA, you need 2 years job history. You need 2 years job history on any loan types, but on conventional, you can sometimes do things with a year based on kind of like the scenario for the specific buyer.
Okay.
But yeah, don't just start working less. You know, now you can have things that happen. You can have, you know, like go on maternity leave, that type of stuff. That just has to all be documented,
Right.
and there are ways to deal with it. But I would say that if you are an hourly employee, which most people are, just make sure that you're getting 40 hours. And if you have an opportunity for overtime and you need that additional income to qualify, make sure you're getting it.
Yeah.
You know, if you're commissioned, I mean, just
make more sales.
I mean, all that stuff. Yeah. I mean, you just have to that's, and really, I mean, qualifying is a function of two things, you know, how much you have coming in and how much you have going out.
For sure.
You can make a lot less money than somebody else and qualify for more because you have less going out.
Yeah, exactly. And that's kind of what I was thinking about was like, you know, as far as increasing purchase power goes, yeah, it's really like it's either money or debts, right? And usually a combination of both, right? So, you know, you can always pick up more hours, second job. How does that work? Like, let's say I'm a normal hourly employee. I don't like where my purchase power is at, and I want to start door dashing. Like, how does would I need 2 years of that? Or
yes.
Okay.
Yeah. I mean, so if you're door dashing, you know, that's self-employed income. So yeah, 2 years.
So you really couldn't count it until...
And you need 2 years taxes. You need to report it for 2 years on your taxes. It's going to be averaged over 24 months. If you have a second job and you're W-2, you need 2 years job history of a second job.
Okay.
And so to use any of that type of income, you've got to show 2 years history. And you can be like, you can, you know, work one place part-time for a year and a half and get another job at another place part-time for the last 6 months. You've got 2 years of history. It gets averaged. Right. But yeah, I've had situations where people are like, yeah, you know, I got this second job, you know, like a couple months ago for this extra money. And it's like, that's great, but we're not going to be able to use it.
So there's not really a quick fix on like increasing purchase power besides like dumping your debts, right?
Yeah. So, I mean, we've had this conversation before, like when's the right time to get pre-approved? And it's like, you know, it might be a year out. Do you know what I'm saying? Like, so it could be because you need to, oftentimes until a lender actually takes a look at it and builds the file out, it's very hard to advise somebody as to what their actual situation is. And so, but the other thing is a co-borrower, you know, and I've had situations where I've had, you know, somebody's parent co-sign. Right. Now, the buyer is making the payments. They can make the payments. Like based on their budget, they can make it make sense. But again, we have to fit in this underwriting box, whether it's below 50% or 56.99%. And so they bring a family member on or somebody, you know, who's going to move into the house with them as well as a co-borrower, and that can and I mean that's a pretty common way to like solve that
for
problem.
Sure.
Is to
that's
get
how I
somebody
qualify
else
for my cars that were too expensive for me.
Yeah, and so I think that's one of the things that, you know, my son, you know, he ended up out in California in the Coast Guard, and he starts like shopping for a car. We had a car, and we had this Soul, and he's like, yeah, I'm not taking that with me.
Like, come on, Dad.
And so I sold it, and then immediately he's got like a 17-mile drive. He's actually got like a 5-minute swim to his base, but he's got to like drive around. And so he was able to do that on his own.
There you go.
But yeah, I think that co-borrowers, you know, FHA, you know, they're going to have different rules as to who can do it, but typically family members, you know, relatives, that type of stuff. And that's probably the easy button, you know, when it comes to qualifying. But it's also one of those situations not everybody has. It's like gift funds for a down payment.
I was just going to ask about gifts.
Yeah, people will be like, "Hey, just get gift funds." Well, I mean, like, not everybody's family has the capacity to.
My dad doesn't have the inheritance rolling through, you know.
But a co-borrow, that's probably the easiest way if they like, if they're not going to drag down the
Right.
file with like a score or something like
Right.
that.
Okay. That makes
Because you have to
sense.
count for their debts as well. So if they have a mortgage,
Right. Exactly.
yeah.
Yeah.
But I've had situations where we're $700-800 away, and we just get it figured out. And
Yeah.
then at that point, down the line, if the situation changes, they can refinance and take that person off.
Yep. That makes sense. Cool.